Jim, thanks a lot for being our first interview on Zer0es TV. You are the Dean of Short Sellers, so really excited to talk to you here.
Thanks for having me.
What's really interesting is how you got into short selling and how you've managed to stay in it so long. Considering the number of years you've been doing it, 30 plus years, a lot of guys who are long only have since blown up. So the fact that you've been able to thrive and stay in the game is amazing.
And given that a Bloomberg reporter today put out a tweet with the graph of the most shorted stocks over the past year, saying "Rest in peace, shorts." It's nice to see that the afterlife for both of us is treating us as well as it is.
As I understand it, the way you got into it was you were working as a sell side analyst and you put out a negative report on Baldwin United, which turned out to be prophetic. But your reward for that was you were ultimately asked to leave the bank. Do I have that correct?
Well, not quite. It was you're off by a couple of years, but first report I ever wrote was a sell and sell short report on a company called Baldwin United in 1982. But what makes it so funny and ironic is I put it out on the absolute day the market bottomed. I think it was August 17th, 1982. So it gives you a good sense of my sense of timing and all this stuff. And Baldwin ended up going bankrupt in early '83, and I sort of got the sad idea that maybe there was a market niche to be done in research, because our clients at the small firm I was at, Guilford Securities, asked my boss, well, what else does the kid not like after that company collapsed? And so we thought maybe we could do it in the form of institutional research. I then moved on to Deutsche Bank in New York later that same year in '83. They hired me and a salesman, and we did our thing in the bull market of the mid '80s until I was featured on the front page of the Wall Street Journal in 1985 on a story about how evil short sellers, were conspiring to bring down these otherwise fine companies. There were 10 companies mentioned in that article, and 9 of them either went bankrupt or were prosecuted for securities fraud ultimately. But my bosses at Deutsche Bank did not apparently approve of that, and I know that might bring a smile on your face given your views on the Germans. But I was asked to leave, that my contract would not be renewed. And luckily, I had a wonderful client who thought it was the best news ever. I didn't quite see it that way, but they then set me up in business. And so Kynikos was formed on October 1, 1985.
If I understand what you're saying, then when you first decided to focus on short selling research, it was really a commercial decision. Was there any thought that you found yourself here? And the reason I ask this is because you came from, you had a great pedigree. I think you had gone to Yale. You were a very institutional guy, or you could have become. Was it just that this was an area that others weren't really paying attention to, or did you feel like it actually fit well with your personality?
Well, I think maybe ultimately it turned out to be the latter. But the decision was really was commercial one. As you said, I went out of Yale into investment banking and then into research. Although when I went to Wall Street, the first guy that hired me at Blythe Eastman Payne Weber just was absolutely gobsmacked as to why anybody would want to go to Wall Street in 1979 or 1980. It was not the place to go back then. That all changed in '82. But in any case, it was a commercial decision. But as time has gone on, I do think I've sort of changed my view. I always thought that at first the short side was the mirror image of going long. Just you did the same types of research. You hopefully ascribed valuations and risk probabilities for outcomes and things like that. But as time has gone on, I've learned that at least on the behavioral finance side of the equation, it's not the same. And there's lots of asymmetries on the short side, as you well know. But I also think the personality aspect is somewhat different, and that probably short sellers, by and large, are somewhat born, not made. Anyone can learn the research, but you have to be able to take the concept that everyone almost all the time is going to be telling you you're wrong, and that's just really really hard. And there's lots of academic research that backs that up.
Well, another dynamic that I think is also pretty interesting when I look at your career, you're based most of the time anyway, I think in New York, and you move in, I think, a number of the same circles that guys who are long and strong, the names you're shorting, are in. Is there an odd dynamic socially or when you're at professional events when you talk to some of these high profile managers who are along the things that you're publicly short?
I probably hang out in those circles a lot less than you might think, but I look, it comes with the territory, right? I mean, I grew up in the institutionalized world of Wall Street in the 80s and 90s, and also was fortunate in terms of the idea of the growth of hedge funds and alternative investments. So, I've seen that throughout my entire career, and I think it's much much better now than it used to be. I mean, trying to sell the idea of being short stocks as a hedge to a long portfolio or to finance a long portfolio, and maybe we'll get into that in a bit, was just completely alien to institutional investors for the most part in the late 80s and even into the 90s. It wasn't really until the dot-com era that hedge funds began, long short equity hedge funds began to shine, that institutions kind of woke up to that. Prior to that, it was just the purview of family offices, high net worth individuals, and a certain number of hedge funds that had proved their worth. And you could count them on one hand, Tiger, Steinhardt, Soros, Cumberland. And there really only were 4 or 5 of them. So we were I think in the top 10 largest hedge funds in 1990, running a little over $600 million. I mean, that's how much this business has exploded. People don't realize what a small business it was until really, the late 90s.
Getting back to that point that you made, that you think short sellers are born and not trained. One of the things I'm really curious about when I talk to other short sellers, if we really get into in-depth conversations, is to what extent do you have long equity investments, or do you really believe in long equity investments?
So we have basically what I would call 2 different silos or pools of capital, either through partnerships, offshore entities, or managed accounts. And one would be short only, and that's the oldest business that goes back to 85. And that's basically for people, and our view is that always, in effect, as a business proposition and an investment ethos, we're in the insurance business. We're basically insuring your portfolio. We don't want clients, for the most part, to think, well, the market's going down, so I want to put money here. Every once in a while that changes. We might be in one of those situations right now, by the way, where actually just things look so speculative that you may want to have 1% or 2% of your assets in the crazy stuff. But by and large, our whole idea is that a diversified, fundamentally chosen short portfolio that underperforms allows you to be more long, and allows you to finance your long. So for the first sort of 10 years of Kinnikos, we provided the short portfolio for people that had the long side. When our business model changed in the mid 90s with the advent of partnering with a large family office, and they basically came up with the idea of marrying our short portfolio with their long portfolio, and began compensating us on an alpha basis, on a relative basis, and with the idea again being a married insurance product. And we've subsequently offered that ourselves. So for clients that just don't want to be bothered, we have a hedge fund, a more traditional hedge fund, that is both long and short. What makes it different is that virtually all of the long side is passive, with some
Hmm.
exceptions. But the idea being, again, indices are just fine for what we do. We want to spend all our time on the short side. That's where our alpha is highest, where our time value is highest, and then we just want to take out the systematic market risk to some level based on market environment. And that's worked out very, very well, maybe with the exception of the last few years. But the returns in that strategy have been terrific.
When it comes to your personal investments, I mean, to what extent do you really believe in long equities? And the reason I ask this is I've been doing this as a short seller 10 years, and I think that it's a very strange thing that my reward center is lit up when a stock goes down. When I feel good, when I make money, it's when something craters. And I think that that different incentive system has colored my outlook, if not the entire world, at least on the markets. And since you've been doing this a long time, really curious as to, since the incentives are fairly similar, on my side and your side, I mean, has that changed how you view long equities? Has that changed how you view the world? Or am I just maybe one of the more skeptical people among skeptics?
Well, again, with the proviso that most of my net assets are tied up one way or another in the firm or in personal real estate, or things like that. I would say that I'm probably a little bit more market agnostic than you are, in that in our hedge fund, we're always basically net long. I mean, it's sort of 0 to 100%. I think right now we're somewhere around 55% net long. And so we're always going to have in the hedge fund a long bias with the short overlay. So I'm generally of the belief that financial assets will appreciate over time. I think probably not to the extent they have in the last uh, 30 to 50 to 100 years, but will probably provide positive returns. That's not to say, however, that all companies will. And corporations have a very high failure rate, which is another reason why it's so hard to beat the indices. The indices self-select, and we get that. But choosing large numbers of stocks, studies have shown if you just choose large portfolios of stocks at any given time and do nothing, your returns will be generally well below the indices because of failure rates. Again, it gets back to the difficulty of beating the market, and particularly beating the market on the long side. I guess it's a long-winded answer of saying I'm probably a little bit more market agnostic, but there are times like right now where I just could not see in the hedge fund being close to 100% net long. It just I think we're seeing all the classic signs of a retail-driven mania at this point.
I'd love to get your thoughts on that, and I do want to go back to your business and this comment that you made about it being an insurance business. But since we're on the present market, I mean, what's amazing to me is that in March, at least, it seemed like the world was falling apart. I didn't think that these balance sheets that had been made so fragile since the financial crisis, these corporate balance sheets, I didn't think that the Fed and other central banks could essentially bail them out. I've been shocked. I mean, what was your view at that point in time? Did you expect that the liquidity would have this kind of effect in both credit and equity markets? And I mean, is this, you know, so is this pretty much what you thought would happen? And where do you think we go over the next 6 to 12 months?
Whatever your views on the Fed are, and everyone has one probably, the idea that this Federal Reserve and the ECB and the JCB would not attempt to rescue asset markets, I think would be ill-advised. I mean, all the signs are there, but they've been there for years. I mean, I put them really at the rest of 1998 with the Fed quasi-rescue of LTCM. For those that forget, the Fed had been tightening in 1998 because the economy was galloping along, inflation was starting to pick up, and of course you had an increasing uh, amount of speculation in the equity markets, particularly in the U.S. After the advent of the Netscape IPO in '95. By 98, people were in full bore speculation mode. And that all came to a halt in the summer of 98 with the debt crisis in Russia and then the LTCM. And the Fed reversed itself on a dime when the markets buckled 20% and began easing. Now, they reversed that again into 99 and into 2000, but the market signal was given that the Fed has your back. And that produced the final blow off that we saw. I'm going to point to this cycle, not to the pandemic, but to Christmas Eve of 2018, when the market again, the Fed had been tightening for a few years, and the market had a growth scare and took a tumble after a pretty speculative market in early 18 and was down 20%. And the Fed completely panicked or changed course a la 98 and announced a pretty aggressive easing program, which has brought us 2019 and 2020. And so I think this is just a continuation of what we saw in Christmas of 18 when Powell blinked, the markets forced his hands. And it's pretty clear at this point that the Fed cannot engender inflation as much as they try, but they can engender asset inflation, which they seem perfectly comfortable with until it doesn't work. And I would point out it did not work after the break in 2000. And from 02, I think the Fed funds rate went from 6% to 1%. And from 2000 to 02, as the Fed furiously eased as that speculative bubble burst, but the S&P went down 40% and the NASDAQ went down 80%. The genie was out of the bottle at that point. So it works until, it doesn't work. And who knows when that is. But it's very clear that the central banks have put financial market dislocations as part of their third de facto mandate, along with unemployment and inflation. We just can't have any risk that markets could go down in any meaningful amount. And it's all part of the financialization of the global economy, which has been going on since 1980. It just finance and markets are a bigger part of the global economy. And so the markets wag the market tail wags the economic dog, and that's just getting bigger and bigger.
Absolutely. So given that we've had 12 years of pushing asset prices up to the moon, when you're dealing with potential clients or actual clients, they come to you for insurance because they're along the world. I mean, how does it really work? At what point do they ever say, listen, we get that the markets shouldn't be here, but we just give up. We're not going to insure the portfolio anymore. I mean, has that been a factor?
That happens plenty. As I have been joking in kind of gallows humor, the proposition that I sell a $1 bill for $10 is awfully appealing to many clients and potential clients until the dollar bill starts trading at $12, and then the view is, well, why can't it go to 15? And the answer is, of course, it can, but it's still a dollar bill at the end of the day, and at some point we'll probably trade back at $1, if not a discount to that dollar. And so that's always the problem, and particularly as you get toward the tail end, and I faced it in the late 90s as well, as things went parabolic. And at some point, when things get so crazy and so detached from reality that you can't basically say, well, all right, I think this company is worth $10. It's trading at 100, but it was just at 90, and I can't tell you it's not going to 120 or 150 or whatever before it goes back to 10. And that's always a difficult situation because recency bias and lots of other things point to people saying, well, you could have said that at, and of course, when markets turn, stock prices don't care, and when they do find their true clearing level, it's often shockingly lower than people think. But on the way up, it's certainly logic takes a back seat to price performance and momentum.
Picking up where we left off when we had some COVID world induced technical difficulties. It'd be really interesting to relate something that we're seeing today with one of your, or I guess a theme that you previously shorted back in the 80s. I know right now you guys are actually, you're looking a lot at commercial real estate and you think that there are a lot of potential shorts there. But you've done this before. You've somewhat seen this movie before, especially in the SNL
Yep.
days. Can you talk about what you've seen before and then relate that to the work or what you're seeing right now in
Yep. So
CRE?
like a lot of hedge funds and short sellers, we were short credit and a variety of residential real estate stuff in the before the GFC. But where we really made our chops and the big short for us in real estate was not '05, '06, '07. It was '87, '88, '89 in the U.S. commercial real estate bubble that happened back then on the back of the S&Ls and Drexel Burnham and very importantly, tax law changes that occurred in '87 that completely upset the apple cart, as well as the oil crash, which started the dominoes falling in Texas. And back then, it was based in basically in offices, and then to a lesser extent, retail and malls and things like that. It's very interesting to us, having looked at macro numbers, of just what a boom we've had in commercial real estate in the last 10 years. I know everybody focuses on residential, and lately residential has been in the headlines, but the amount of credit that's been extended to commercial real estate and the amount of commercial real estate loans that are out there are really quite large. We took a look at just the troubled areas, which we would call office, retail, hospitality, and gateway city multifamily, meaning cities like New York. And if you assume 50 to 60% LTV on these properties, which I think is about right, we estimate that the amount of debt, both in the banking system and in the non-bank financials and CMBS, we estimate it to be about $6 trillion, or roughly a little bit more than half of the $11 trillion of value in those subsectors. And to put 6 trillion into perspective, in the subprime and alt A ended up being about a trillion eight back in '06, and that was 15% of GDP. Commercial real estate exposure back in '89, also the debt turned out to be about 15% of GDP, and it sunk the banking system back then. Right now, that amount of commercial real estate debt, just in the troubled sectors, is about 30% of GDP right now. It's twice what it was in the late '80s and before the GFC in terms of problematic areas. And so it's quite large. And not enough people talk about how much debt is out there on commercial real estate, which, depending on your point of view, is either somewhat challenged or will get severely challenged going forward. And it was, by the way, it was getting challenged before COVID. We were getting
Right.
overbuilt. The office vacancy rates before COVID in urban markets in the US was 14%. And the all-time high was 19% after the '80s bust. I mean, we're already had too much office space, and everybody, has known we've had too much mall space for a while. But this was not just COVID.
For your thesis then on commercial real estate and that there are a number of compelling shorts related to that, I mean, what outlook do you need to have on rents, vacancy rates? Are you taking a regional
Yeah.
approach, or do you think this is something that's a national problem?
Again, like in the late '80s, even though it ended up becoming a national problem, because real estate is the ultimate local business, we focused first on Texas, then things like Phoenix, Miami, where there was aggressive lending, and similar to the residential in the GFC, where there were, certainly the Sunbelt cities like Vegas and Miami were far worse than say northeastern urban centers. It's the same right now. I mean, clearly, gateway office buildings are challenged. Large malls are challenged everywhere, and as are hotels. We're avoiding residential. That's not where this is. That's not where the problem is, at least not yet. And we're avoiding suburban multifamily, which is generally fine. But then you get into subsectors, and you just see, you're seeing just rapid rent erosion already. And what's so interesting about this cycle is that despite all this happening, because of the Fed's interest rate policy, cap rates for these companies and projects are still really low. So, I mean, what we consider some pretty troubled real estate companies, REITs, office REITs, whatever, are still trading at implied cap rates of 4 and 5%. And that's amazing to us because it means you could lose, not only can the rent rolls get worse, which I think they will, but you could lose because rates go up, or you could lose because spreads widen out, or all three. And it's amazing just how priced to for perfection this sector is, even though the stocks for most of these guys have come down 30 to 50%. They're so levered. If you take a look at some of the biggest players, for example, you just look at Vornado, which is just sort of the class act in New York City. Their rent revenues are down 25% year over year, and their net operating income is down about 30% year over year. And I mean, those are stunningly large drops. Vornado trades at a 5% cap rate.
That's incredible. It's hard to understand why these risks aren't being priced in. But if we think about these risks coming to fruition, how far does this go? Do banks get recapped?
Well, there's a little twist to this story, which is normally you get accounting changes at the end of a crisis, right? We saw the change to mark-to-market accounting in March of '09 after the GFC occurred, and banks had to could stop marking their assets to market, including their derivatives. The damage had already been done. So this time the government didn't waste any time, and in the CARES Act is a provision that suspends GAAP accounting for any assets that may be deemed affected by COVID. So banks have taken advantage of that to take loans and put them in what's called deferral now. So there's a new category, in which case the borrower may not be paying you, but you can still accrue interest if you deem the loan affected by COVID. And same thing in real estate. A tenant may stop paying you, but if you deem it because of COVID, you may still recognize the rental revenue and just put it in a rental receivable. Now, you're going to have to make a decision before the year end on this, according to the law, although it may get extended, of course, and either take the loan off of deferral and either put it in performing or non-performing, or, and this is what I think we will see, declare the loan impaired for COVID over the life of the loan or the life of the lease, and therefore, continue the fiction. So this normally occurs, at the end, as I said, after the losses have occurred and the accountants kind of scramble to make sure it doesn't get any worse. In this case, this got passed in March. And so it has the effect of actually making some of the banks and some of the REITs and landlords look a lot healthier than they really are right now.
Does that risk our banking system going the way of Japan following the 90s, where these banks just became zombies? They weren't writing off the bad loans, but by the same token, they were largely paralyzed and weren't extending a lot of new credit.
Yeah.
Do we run that risk,
or on the other side of the coin, a country as well as I do, China, where they not only grow the banking system really fast, but they also just keep extending new credit to the non-performers to keep them performing. So sort of a super extend and pretend. I don't know. We'll have to see. It'll be very interesting to see what happens come year end and whether there's pressure from the banks and the real estate interest to extend this provision. But yeah, right now we're not on GAAP accounting for a huge amount of these assets. And I still don't think the market appreciates that to the extent they probably should. I looked at one REIT today, and I think 60% of their rental revenue they did not get in cash in the second quarter, but they recognized it.
Jim, if you could take us through one of the 1980s shorts in commercial real estate.
Yeah, the first place I looked, our mutual friend Jim Grant introduced me to a wonderful guy down there, Fred Rowe. Everyone knows him as Shad Rowe. he called me up and said, Chanos, you got to get down here. So I spent a week with Shadrow in the spring of '86. I just opened my hedge fund that previous fall. And Chad drove me around Dallas on the LBJ and the Stemmons. And this was sort of the peak of the building boom in Texas, the back of the oil boom. The oil was about to crash in '86. And, uh, and the buildings were called see-throughs because they had very few tenants. But my epiphany moment came as we pulled into the parking lot of one of these things on the LBJ one afternoon, and it was 2 o'clock in the afternoon, and it looked like the parking lot was maybe about 10% occupied. But the building was open. We walked in, and they all were the same. They had these, mirror glass exteriors, atriums. I mean, almost all the buildings were kind of cookie cutter kind of buildings. They're all still there, of course. And Chad said, take a look at the directory. So I walked over and looked at the office building directory, and they were all on walls back then. They weren't digital. And the light bulb went on because virtually every entry on the office building directory was either an appraisal company, a title company, a syndicator, or a broker in real estate. And so literally, it would become the ultimate, Zer0es reflexive economy that these buildings were being built and mostly were housing, real estate related services. They didn't have any really corporate tenants. It just became very clear that there was a real problem in these buildings. And we began looking for the lenders. And then the double whammy of the oil price shock hitting and then tax law changes a couple years later finished them all off. But that is what I distinctly remember of my days in Texas. And we ended up being short Southmark and Southland Financial and just a lot of the S&Ls down there. And then SunTrust Savings in Miami, and of course Charlie Keating's company, American Continental, which owned Lincoln Savings and Loan in Phoenix, and just a whole host of things. It was quite a crash, and also it was quite a bit of criminality. Over 3,000 bankers went to jail after the S&L prosecutions. Far more than the GFC, of course. In any case, that was the moment in my days, my first foray into commercial real estate on the short side in the late '80s, mid '80s and late '80s, was traipsing through empty office buildings in Dallas, Texas.
And I take it that you don't see that kind of criminality present today in the commercial real estate market. That's not part of your thesis.
No, no. Making loans to your buddies or your family, which was just epic. And you have to remember that the regulators were consciously looking the other way in the '80s because they were trying to save these savings and loan, whose main problem was interest rate mismatch earlier in the decade. So they were all underwater on their mortgages. The regulators actually were letting them do things like regulatory goodwill as part of capital and let them get aggressive into construction lending and lots of them buying junk bonds. So if anything, the regulatory environment was so lax, it encouraged it. I think we're seeing that kind of regulatory laxness in other areas in the market, but not in the banking system. I think that after the GFC, and banks are, by the way, pretty well capitalized. I mean, we're short some regional banks that I think have some real problem concentrated portfolios. But this is not like the banking system in '06 or even the S&Ls in '89. I think the problem is going to be more in leveraged real estate companies themselves.
And final question on that: when you're looking at CRE today, are there any companies that have outsized exposure to, say, WeWork? And does that even matter as far as your thesis is concerned?
The answer is yes. Some of the gateway office REITs have 10, 20% exposure to WeWork in certain of their buildings, so it's meaningful. But I mean, I think that it's a broader problem than that. I think that as the rent, basically most office leases have about a duration of 7 years in most REITs. So about 15% of your portfolio is rolling off every year, sort of no matter what. And I think that's the real problem is where do you release that space, at what rates, what discounts? And the other interesting thing is, in addition to the CARES Act accounting, as landlords get more aggressive, we're seeing another accounting issue, which is capitalizing of incentives. So if you give free rent or if you give build out allowance, often the real estate companies are capitalizing that and writing it off over the life of the new lease. And so that expense, which you would normally maybe expense, is not showing up in NOI right now. And so a lot of the NOIs that people are looking at to gauge cap rates and dividend payment with wherewithal are also inflated in other ways. And so it is kind of an interesting accounting puzzle.
Okay. Well, Jim, really thank you for a fantastic interview, and thank you as well for resuming it. Yeah, learned a lot from this, and this is great material.
Oh, thank you guys. Appreciate it. Good luck and look forward to seeing it.